I'm John Gwynn.
And I'm David Hill with PriceKubecka.
Today we're going to talk a little bit about oil and gas depletion, both from a U.S. GAAP perspective as well as a tax perspective. I'm the audit director for the firm, so I'll talk a little bit about the two U.S. GAAP methods that are accepted. They're called successful efforts and full cost, and David will talk a little bit about the tax methods.
Right. Now for the tax method, there's two types. There's percentage depletion and there's cost depletion.
Under U.S. GAAP, there are two generally accepted methods to account for oil and gas properties: successful efforts and full cost. So as a small business, if you're just starting to decide on which method to use, there are a bunch of different ideas that go into choosing the method. Full cost is probably the easiest to account for. It doesn't take a lot of time. It groups all of your properties together by continent or region. Successful efforts, you have to go to a lower level of accounting for it by well, property, field. So if you have the resources to do the accounting for it, I'd recommend successful efforts. One of the main reasons for that is if we ever do adopt IFRS, successful efforts right now is the most closely aligned with companies that are doing IFRS accounting. A couple other considerations to look into. Full cost method: if you sell properties or if you drill a dry hole, then you don't get necessarily a benefit out of it on your income statement. It all just remains within that property group, so there's no real P&L impact to it.
Okay, I'm going to talk about the tax methods for deducting depletion. John covered earlier the cost method, and that is also allowed for tax, but we use a little bit different base, but it's the same formula. That's an allowable method, and there's also another one, percentage depletion. This is allowed by Congress, and this is available to people who own property in the U.S. and who own an economic interest. It's not available if you own a refinery or you're a retailer. Now what this is it's a deduction. It's 15% of your gross proceeds. And what this does is it gives you that deduction on your tax return, which helps minimize your tax liability. It is subject to two limits though. One is it's done on a property by property basis, and you can't create a loss with depletion. So there's that 100% of all your taxable income. Now the other one is a 65%, and this is for everything you do, not just oil and gas. In this scenario, you can't take it below that level. And that's the only two limitations for percentage depletion on your tax return.
So those are some of the ideas we wanted to give you on how to account for your oil and gas properties and the way to do depletion. If you have any questions or need us to help you out in any way, please give us a call. We're with PriceKubecka.